Okay, this session will be on initially on the session will be a summary session on insurance services. So we will learn about basic things associated with insurance services, and what are the important parts, what are the examinable parts, and what are the things we should learn about insurance service. So even in our day-to-day life, these things are matter and these things are important. Okay, so so we shall first learn about what is a insurance and what is really happening inside the insurance. Okay. Now, every individual, as well as businessmen, normal day-to-day life persons, they all face risk. Okay. Now, one thing with the risk is we know that there are risks. අපි දන්නවා අවදානම් තියෙනවා කියලා, but we cannot identify with a certainty when and where they will come. We don't know when and where the risk will arise. Okay, we know there are risks. We know sometimes our vehicle might hit a tree, but we don't know when or where. Okay, we know that now. Very recent thing is last few days back, I think there was an earthquake in Thailand. Okay, we know earthquakes are happening, but we don't know whether it is happening in Thailand or Japan or wherever. Okay, so some time back we noticed that in US there was a large fire. Okay, and there are a lot of storms and stuff. Okay, so instant fire, storms, floods, tsunamis, earthquakes, accidents, riots. Okay, those are the risks. Those could happen at any time. So in order to face this risk, what happens is people or humans have built up a systematic method. Okay, so insurance institutions are those institutes or the people who give this systemic method to to minimize the risk. So in summary, there are risks and we don't know when and where these risks will happen. For example, some of these risks include instant fires, storms, floods, tsunamis, earthquakes, accidents, riots, and so on. And in real life, we need some systematic method to minimize this risk or avoid this risk. Okay. And for that, what happens is insurance companies are being set up to help us out. Okay. So the basic of insurance companies is they accumulate risk. Okay. They accumulate risk. What they do is they accumulate risk. What happens is, let's say now there is a group who own cars, okay, and they think sometimes their car may meet with accident. So what happened is these people they get together, or the insurance company come and say, okay, you guys get together and we will be setting up a insurance fund for you, or else insurance for you, where premiums will be collected from each and every one in that group, and they will set up a insurance fund. So if something goes wrong, or if something, let's say one of these individuals, if their car got hit with a tree, what happens is they will pay out from this insurance fund. Now the important thing is, now none of them know when that will risk will happen to them. Okay, that pool who were the car owners, they don't know when that bad thing will happen to them. But every one of them focus, okay, so at some point of time, this could happen to me. Therefore, what they do is they will pay insurance premium and get themselves insurance covered. But on the other hand, from the insurance fund side, they also know with a probability not all of these people will face the insurance risk, or else not every one of them will face a car accident. Some of them will face it. For that, they will pool out these funds and maybe they reinsure it or they will invest it. And if something goes wrong, they will pay out these affected parties. Okay. So insurance accumulate the risk of all into a single insurance fund. Hence, insurance is known as pool of risk. So they are pooling the risk. They pool the risk. There were 50 individuals who were having the risk of car accident. What they did was they pooled that risk into one single pool and they collected premiums. Okay. Even though they have that risk, not that 50 people will have car accident in 1 year. Okay. Maybe one or two. Okay, we don't know who, where, or when, and the severity. Okay, that is the nature of the risk. So insurance is established to share financial losses. Okay, share financial losses among participating individuals of that insurance fund of one of individuals who have won the risk with the difficulty. So what happens is you have 50 people who are sharing the risk, but few people, one or two people will face the risk. Okay, in reality, insurance is a pool of risk where the losses of one party are shared collectively. As I said, what happens is you have 50 people who anticipated that risk will happen and they premiums, but in actually one or two people will meet with that accident. Okay, but we are afraid, or we are scared that risk will happen to me. මට හරි බයයි මට ඒ risk එක වෙයි කියලා. මට බයයි මගේ කාර් එක හැප්පෙයි කියලා. There are like 50 people 50ක් විතර ඉන්නවා. එතකොට ඒ 50න් ඒ 50 විතර මගේ කාර් එක හැප්පේ. හැබැයි යාලා දන්නේ කවදද කොහෙදද කොයි වෙලාවෙදි කොච්චර ලොකු ඩැමේජ් එකක් වෙයිද කියලා. එතකොට එයාලා ඉන්ෂුරන්ස් ෆන්ඩ් එකකට සපෝට් කරනවා. එහෙම නැත්නම් ප්‍රීමියම්ස් ගෙවනවා. එතකොට ඒ ඉන්ෂුරන්ස් ෆන්ඩ් එකෙන් අර ඉන්න 50න් සමහරකට එක්කෙනෙක්ගේ කාර් එකක් හැප්පෙන්න පුළුවන්. එතකොට ඒ හැප්පුණ එක්කෙනාට ගෙවනවා. So what happens is their losses is being shared. Okay, so insurance is assignment or as agreement between two parties. Okay, now even though it is agreement between two parties, if you look at parties involved in insurance, there are three parties. Okay, so the first party is the person who obtains the insurance coverage. Okay, there is the insured one. Okay, let's say I have a car, I want to get a car insurance, then I am the first party. Okay, second party, the party who provides the insurance coverage. Second party is the party who provides the insurance coverage. That is the insurer. Okay, insurer is the insurance company. For example, Sri Lanka Insurance or Softlogic Insurance or else Union Insurance, Selinco Insurance. Likewise, there are a lot of insurance companies. Then you have the third party. Okay, all the other parties and properties who will be affected by insurance contract. For example, let's say I have a car and I think that I need a car insurance. Then I will take the car insurance. Okay, then I am the first party. Okay, and I took it from Sri Lanka Insurance, and Sri Lanka Insurance is the second party. Okay, people who gave me the insurance coverage. And let's say something bad happened. Okay, and I hit a let's say I hit something. Okay, then the parties who are affected by it are the third party. For example, let's say passengers in that vehicle. I hit some vehicle and the passengers in that vehicle itself. Okay, that is the third party. Then okay, practical life එකදී ගත්තම අපි කියනවා අපිට insurance එකක් ගන්න ගියාම we take a first cover. First party insurance එකක්, third party insurance එකක්. First party insurance එකක් කියන්නේ if something goes wrong, I am insured, so I can get the insurance coverage. Third party means I cannot get the insurance coverage, but the party who was affected by me will get the insurance coverage. Now, every vehicle on road should take a insurance. Okay, at least a third party insurance. Okay, so we have the option first party or third party. First party is expensive, third party is not that expensive. Okay, so then we have the principles of insurance. As an insurer, as an insured, you have principles of insurance. Those are insurable interest, utmost good faith, and indemnity. So let's look at them in detail. Okay, insurable interest, the legal right. Okay, the legal right to obtain an insurance coverage for a life or for a property is known as insurable interest. Okay, now let's say now take the home that you are in. Okay, you are in your home, you are in your parents' home. Do you have an insurable interest? Do you have a legal insurable interest over your home? The legal right to obtain an insurance coverage for the life or for the property. Do you have a legal right? Or do you have an insurable interest? No, you don't have. But your mother or father will have. Either the mother or father who have the ownership of the property, they have the legal right to obtain the insurance coverage. Okay. Now, husband and wife will have insurable interest for each other's life. Okay. Then property insurance, the legal owner of the such property has the insurable interest. Then if you look at banks, the creditors have insurable interest over the life of the debtor up to the value of the loan. That means for banks, if they let's say they have given a loan to someone, then they have an insurable interest over that loan up to the period of uh, lifetime of that loan and maybe the debtor. Okay. Then utmost good faith. Okay, utmost good faith. So this principle states that both parties in the insurance contract should disclose all the relevant information accurately for the contract. What does it mean? Okay, let's say that I am going to take a insurance, and then I have some serious illness. I have some serious illness where I will occasionally get sick, and that is a very critical matter. But I do not disclose it to my insurance contract. I mean, to my insurance company, I do not disclose it. I do not disclose that I have such a health condition, and I take a life insurance coverage and health insurance coverage. Then that is not utmost good faith. Okay, and on the other hand, let's say insurance company, they are saying now it's usual that they give, like, for let's say for accident coverage, it's very usual that they are giving the coverage for let's say motorcycle accidents, but suddenly they do not disclose it. Likewise, they are not disclosing. Okay, so parties involved in the contract are insurer and the insured. The insurer is the insurance company, and insured is a party who has obtained the insurance coverage. If either party, so the important thing is either party, it could be either insured or insurer, does not disclose any important information, it will be a breach of utmost good faith. It will be a breach of utmost good faith. Then both parties have the legal right to cancel the insurance contract. For example, let's say I did not disclose about my health condition. Then insurance company can say, no, I'm not going to pay you because you did not disclose it. Okay. Now, what really happens in this? Now, if I disclose that situation, they might increase the premium because that is a risk. Okay. So if, let's say, if insurance company do not disclose, okay, if they lie, sometimes I might not get that coverage from them. Likewise, it can be work out either way. So both parties have the legal right to cancel the insurance company in case of breach of utmost good faith. So indemnity. Indemnity means that if a loss occurs in an insured property, the compensation paid should be sufficient only to reinstate the damage to the previous state. Okay. So this principle does not apply for life insurance, but for the property insurances, maybe car insurances and all that, housing insurances and all that, this applies. So let's look at it. When a motor vehicle having the value of 2 million is insured for the same value. Okay, so vehicle value is 2 million and owner took the insurance coverage for 2 million. The compensation of rupees 500,000 can only be obtained for a damage value of 500,000. Make it may indemnity. Now let's say you have a vehicle which is 2 million and you go to an insurance company and take a 2 million insurance coverage. Okay. And suddenly you go and hit a tree and vehicle damage is 500,000. Then even though you have insured yourself for 2 million, you cannot go and take value more than 500,000 because loss is 500,000. Okay. Loss is 500,000. So you can reinstate that loss. So the compensation paid will be sufficient only to reinstate the damage to the previous state. Okay. So you can only recover the damages to previous state. Now, last time we discussed about a small example. Okay. Now let's say that I had a house. I had a house. Okay. I had a house like this. And something bad happened. Okay. And something bad happened. And then what happened? This house was destroyed. Then, but fortunately, I took a insurance. Okay. Fortunately, I took insurance. Then I cannot build a two-story, I cannot take funds to build a two-story house, okay, from this. That is not possible, okay. I can take insurance coverage only to build that one-story house. Okay. I can restate this to this. I can use this insurance fund to, I can use this insurance funds to reinstate this house to this house, but not to a two-storied house. Okay. So that is what is meant by indemnity. Okay. So then we learned about life insurance. Okay. Life insurances provide vital services for the individual. So if insured party dies prematurely, his dependents can obtain the compensation from life insurance. Let's say you have a insurance coverage which you took for 20 years, and in between the way something bad happened and you died. Then what happens is your dependents, they can obtain compensation from that life insurance fund. Okay, life insurance cover the risk associated with the life of an individual. Life insurance is also termed as life assurance. Accidents, health issues, surgeries undergone by individuals and hospitals, charges, etc., can be included as additional covers into life insurance contract. Okay, now let's say for example, let's say there is a MCQ question. There is a person called Amal. Amal is scared of health issues. He might have some. He is scared. He might get a surgery. What kind of insurance he should get? Answer is life insurance. Okay, answer is simply life insurance. Okay, now then importance of life insurance. Let's see what are the important characteristics of life insurance. Life insurances can be used as the method of saving and investment. Okay, it can be used as a method of saving and investment. Now, why we say that? Because if the insured, let's say I took a life insurance, and let's say a life insurance is 20 years, and I lived up to 20 years, then what happens is the insured survived until the policy matures. My policy is 20-year time period. I am living until that 20 years. Then I can take the insured value and other benefits. Okay, let's say I took a life insurance which is 10 million and 20 years, and if I lived up to that 20 years, then I can take that 20 million life insurance value as well as the other benefits, if they are giving any benefits. If the insurer dies prematurely, the named dependent can obtain the compensation. And if I die before that 20 years, I can take that compensation which is agreed in the contract. So maybe not myself, my dependents can take compensation. Okay. Can obtain financial assistance in case of marriage and education of children. Some insurances come with different features. For example, they might get, now let's say I have a life insurance and my child is getting married. Then sometimes that life insurance will sponsor you for that marriage, your child marriage, maybe education of a child. Okay. So as well, now this can be used as collateral when obtaining financial loans from financial institutions, because life insurances work like this. Now let's say it's a 20-year commitment. Okay. Life insurance is a 20-year commitment. What happened is every month, every month, okay, you are making payment. Every month you are making payment. And let's say at this point, you want to take a financial loan. Then you have this accumulated value up to this. You can use it as a collateral. Okay, you can use it as a collateral. අපි හිතමු 20 year, it's 10 million. And let's say this is after 5 years. So sometimes its value could be 2.5 million or less, or high sometimes. I don't know. Let's say for indicative purpose, it is 2.5 million. Then you can take a loan below 2.5 million. and keep this as the collateral. සුරැකම විදිහට මේ life insurance policy එක දෙන්න පුළුවන්. Okay, so importance of life insurance, you can use it as a method of saving. Okay, if the insured survived until the policy matured, they can take the insured value and other benefits. Okay, and if they die prematurely, the dependents can obtain benefits and compensation. And it will also provide some financial assistance to important things of your family, and it can be used as a collateral for your financial needs. Then we are going to property insurance. We learned about prime life insurance and then property insurance. So property insurance is the insurance obtained to cover the damages that might occur property, such as buildings, machines, vehicles, and inventories. Let's say you have a building or machine or vehicle or inventory. Can you take a life insurance? No, you cannot. You might get a question. Amal has a business and Amal has grinding machines and several vehicles in the business. What is the common type of insurance that he can take? And answers can be life insurance, health insurance, property insurance, and maybe vehicle insurance. The answer is property insurance, because machines cannot get vehicle insurance. No? So machines and vehicle will get property insurance under common thing. So insurance companies issue various type of insurance policies under this insurance. For example, fire insurance, motor insurance, marine insurance, and insurance for natural disasters. For example, you might get Amal has a house and he is scared of and there is a, let's say there is a factory which produce explosives near to his home. So what type of insurance he should take? He should take a property insurance initially, which is a housing insurance, and he should have a fire insurance. Okay, depending on the question, things change. Okay, fire insurance, car insurance, motor insurance, marine insurance, and insurance for natural disasters. Okay. Okay. So what are the importance of property insurance? Property insurance importance. They cover financial losses arising in organization from various risks. Now, let's say there was some fire, okay, there was some occupational hazard, or there was some stealing, burglary. Then you can use your property insurance to cover up the financial losses. Okay. Then facilitate in conducting business operations continuously. Now, let's say something bad happens and some massive damage happens. Okay, if you have insurance, you can cover it up. Okay, you can reinstate your business to previous state with the insurance. So it will help you to conduct business operations continuously. Okay, then supporting both domestic and foreign trade activities. Okay, it will support you in the both domestic and foreign trade activities. For example, let's say now these days we see a lot of cars are being imported. Okay. Export ban is lifted, so we are getting a lot of cars and other vehicles. So when you ship a car from Japan to Sri Lanka, okay, you can get a insurance. Now we have something called Incoterms when it comes to letter of credits. Okay, there we call it CIF value. Carriage, insurance, and freight. Likewise, those insurances are there. Okay, when you are shipped from Japan to Sri Lanka, you have the insurance coverage. So then, let's look at what are the differences between life insurance and property insurance. So life insurance, the value of the policy is dependent on the risk of the life and insured's ability to pay. For example, I can take life insurance for 5 million. Someone else can take it for 1 million. Because its ability to pay is 1 million. But someone can pay only 1,000. So their life insurance can squeeze down to 1 million. And let's say I take a 5 million insurance, and let's say there is president of the country or some high net worth individual. So their risk of the life is different. So their life insurance policy could be different, and the monthly payment. Okay. Then property insurance, however, it is the value of the property. Okay, that is dependent on the value of the monetary value of the property. Then Life insurance, since the damage to the life cannot be reinstated, principle of the indemnity does not apply. Then අපිට ජීවිතයක් නැති වුණොත් එයාගේ ජීවිතය reinstate කරන්න පුළුවන්ද? බෑනේ, we cannot do that. So indemnity does not apply. Since the compensation can be paid only to reinstate the property, the principle of instate indemnity does apply. The property වලට නම් ඉතින් ඒක apply වෙනවා. අපි බලන්නේ කාර් එකකට මොකක් හරි වුණත් ඒ වගේම අලුතෙන් කාර් එකක් ගන්න. ගේකට මොකක් හරි වුණොත් ඒ වගේම අලුත් ගයක් ගන්න. So what happens is principle of indemnity is applied to that. And then in life insurance, you have benefits such as bonus, interest income stuff. Okay, in addition to insured value, you will have them. But property insurance, you don't have such additional benefits. Okay. So with that, we conclude the insurance section, and we learned about few things, important things. So we learned about what is insurance. We learned about pooling risk, and insurance is a systematic method to minimize the risk. And we also learned it is a method of accumulating risk, and premiums are collected to share financial losses of a single individual or maybe several. Okay. So insurance is a pool of risk where losses of one party are shared collectively. Okay. And then we learned about the parties to insurance: first party, second party, third party, important stuff. And then we learned about principles of insurance: insurable interest, utmost good faith, and indemnity. So those things are examinable. You might get MCQ questions. Okay. And then we learned about life insurance, the importance of life insurance, then property insurance and importance of property insurance, and finally the differences between the life insurance and the property insurance. So with that, we conclude session on insurance. So that's some of the content on insurance. Okay.